Hey everyone, it's Ed Kime, CEO over at Quantcha, and welcome to the conclusion of the Quantcha Challenge. It's June 26th, 2015, around 1 p.m. Eastern Time. Let's take a look at our final portfolio. Over the past 8 weeks, we opened and closed 16 positions on those stocks. We had 8 bulls and 8 bears. We won some, we lost some. Today, before the video is recorded, we closed out our final 4 positions among the stocks that were open in the last 2 weeks. So let's take a look at the performance overall. As you can see, since May 1st, the S&P and Dow have lost a little bit, Nasdaq's gained a little bit. Overall, not a ton of movement in the market. May and June, pretty light this year. Some interesting movement in different sectors, but as a whole, not a lot of money to be made if you just played the indices. Now, if you went long short on the portfolio, we've got 2 numbers here to show you today. The first one is an overall gain of 40 basis points. That, of course, is a pure buy-sell gain, not including fees and commissions. If we were to have done that portfolio in our account, we would have lost 1.2% after the fees and commissions were taken out from it. Not a great position to be in, but it just goes to show that overall the market, not a lot of movement, and the bulls and bears didn't entirely go too heavily in any one direction. We were able to see kind of a break-even performance there. Now, when it comes down to our portfolio, after we've closed out all our positions as of this afternoon, we are up 1.9% on a cash basis before fees and commissions. Now, the goal of this entire campaign was to be as transparent as possible, so of course we're going to include the fees and commissions as part of that. So unfortunately, we ended up with a loss on the portfolio, that 60 basis point loss based on the overall fees and commissions that were paid. Now, in the grand scheme of things, this is actually a pretty good performance because not only did we generally beat the market, but we also beat the long short portfolio. So this is something to be proud of, although it didn't quite work out the way that we wanted it to. So what happened here? Obviously, we didn't meet our goal, which was to make a profit on the portfolio. But it's important for us to take a moment and be introspective and transparent to figure out what we can learn from this experience in order to improve our trading the next time around. Now, we'll start off by talking about the biggest mistake we made, which was definitely that we should not have used market orders to open trades. And I hope that when people are out there and they're placing trades, for the most part, you don't use market orders. Even if you're just using a limit with the market prices, that's better. But for the purposes of what we were doing, we made a marketing trade-off to use market orders. And what I mean by that is part of the goal of the Quantcha Challenge was to highlight the efficiency of using Quantcha to find great option trades. You start off with great advice. You take that advice and you plug it into Quantcha, you find the trade you're looking for, and you pass that off to your broker account and you place the trade. Now, realistically, when you get into that trade ticket experience, you're going to want to stop for a second and figure out how you can shave the bid and the ask if they're pretty far apart. If the spread is big enough, you want to shave it down so you can save some money. Don't pay the ask, don't sell for the bid, kind of bring it in a little bit. Now, in our case, because we were trying to make the videos as seamless as possible, we just used the market data and with the market quotes, and we figured that we could make it up with the scale of our profit down the road. And unfortunately, that was arrogant. We really shouldn't have had that view, but we wanted to keep the videos clean and seamless, and we didn't want to spend time or have to do the extra editing and sort of have that moment where you had to sit back and sort of trust that the trades that we were making, we were really placing at the numbers we were talking about. We wanted to be as transparent as possible and to show you how easy it is to place these trades after you find them. However, had we done some basic shaving, and most of the trades we were dealing with had the opportunity to shave on the bid and the ask, had we done that, we almost surely would have been profitable. It would not have taken a lot in order to put us over the top. After all, every single trade we entered was at the worst possible condition because of those market quotes. So we could have improved our lot in every one of those trades. The second issue we ran into was when we were dealing with illiquid options. And this was something that was a bit of a mistake in our research because when we planned to do the Quantcha Challenge, all the picks that we were looking at prior to that happened to be with stocks that had highly liquid options. Now, it was only a couple weeks worth, but generally when we would check in, the trades always seemed to be pretty plentiful and we had a lot of options to work with, so it wasn't too hard to find good spreads and so forth. Now, unfortunately, when you're dealing with the illiquid options, They're harder to enter, and we saw that problem being going in with our market orders. We were taking a big hit on the liquidity going into the order, and then of course they're hard to exit. So if you have a trade that either has one leg that you need to close out before expiration, you're going to take a hit on the way out, and you don't know how big the hit is, and you don't know where exactly the midpoint or the best price you can get from the market maker is, but you're going to take a hit on exit, which we took repeatedly. And at the same time, that also hurt us because we were unable to stick to our conservative spread strategy. Because when you're dealing with illiquid options, it means you've got only a few expirations to work with, and then you've only got a few options within each expiration, and the strikes tend to be pretty far apart. So it's very hard to do debit or credit spreads that are designed for holding on for a short period of time, and you're looking to shave a little bit of money off of a trade because you want to break even around where the money is now. So as a result, we were really, for the most part, unable to stick to that spread strategy that we had kind of wanted to go in with. Another key thing that hurt us here was that of the 16 stocks we worked against with, 7 of them ultimately worked against their picks in the direction that was provided, which is, that's still saying that more than half were correct, which is not bad. But the problem was that not only that 7 of the 16 went against the direction we traded in, but also that 3 of them closed more than 5% in the opposite direction. These were, for example, a bullish trade that closed more than 5% down by the time we closed out our option trade. And we kept track of that to kind of keep a comparison. We were talking about the long short the whole time. And in the end, the long short portfolio was not profitable either. So us being fairly close to that is sort of an indication that, when you pick the right trades, and you get the right calls there, you can be profitable. But at the end of the day, it's all about the picks that you're working with in the first place. And just like with any source of picks, they're not all going to come through for you. And so it's important to have a diversified portfolio and to make the right call on how much you put in as a cost basis for the trades you're working with. Finally, and this is sort of a side thing for anybody who's been following us last few weeks, the trades we made during the last 2 weeks really had a low likelihood of success. And because of the nature of the liquidity as well as the short time frame, we should have skipped them, frankly. We would have been profitable had we not. But what ended up happening was we made a mistake in our timing in that we didn't end the campaign on a monthly or a quarterly option expiration. So as a result, when we're dealing with a week before the June expiration for 2 stocks that were illiquid, we either had the option of trying to do a weekly trade and taking a big gamble on that, or doing a trade that expired 5 or 6 weeks out in July, in which case we knew we would be closing it out within 2 weeks or 1 week in the case of the week 8 picks. And so the whole goal at that point was to just not get murdered on liquidity. And unfortunately, we took big hits on liquidity, and the trades generally didn't go in the direction that we needed anyway. Had we skipped those, we lost a bunch of money on those, and had we skipped them, we would have been profitable as a portfolio. And of course, this is sort of the part of the challenge is, we're sort of working with within the confines of some interesting restrictions just to see how the platform reacts and how they help us find trades under those conditions. Now let's take a look at a few charts. Here's the cash returns for the trades that we made, and you can see they're color-coded based on the nature of the trade. And we're calling out credit spreads versus debit spreads here, just for the sake of putting it out there. There was some questions on the YouTube site about why we were going for so many credit spreads. At the end of the day, you can really see that the debit spread on Green Mountain ended up being the best one for us, but that was just a function of the underlying call being spot on. And then we had, our hits with credit spreads. We had our hits and we had some losses on other credit spreads. What kind of killed us was with the low liquidity ones, which you can see kind of bunched up in the middle there. Even on the stocks that did fairly well against their call, when we were dealing with low liquidity with a market open, you're end up buying a call that has to move massively for it to be profitable. Now, we got lucky with Merit Medical, but with Lionbridge, for example, we weren't as lucky. And so we were sort of dealing with some of the luck of the draw that we could get there. At the same time, kind of switching up a little bit, here's the return rates, the actual rate of returns we've got for the specific trades we went into, just a different view on what we had before. Now, we talked a little bit about liquidity, actually a lot about the liquidity, and here's an example to break down. On the left side, we got the return rates by liquidity, and you can see that we had a 57% positive return for the 4 trades that were based on stocks that had liquid options. whereas we lost an average of 32% per trade on all the illiquid trades, which was 12 of the 16. We could see Las Vegas Sands, Cirrus Logic, Anthem, and Green Mountain all were profitable for us, which was great. Now, of course, a lot of that has to do with the calls just coming through in our favor, but there were a few trades that could have potentially been profitable for us had we had better liquidity, which is just the nature of the market. And when the calls come through, Zacks is making the calls based on earnings and performance and stuff. So a lot of them were good calls on the stocks, and if you went into the stock directly, you would do fairly well. But when you're trading them with options, and especially if you're dealing with market open like we were, it just doesn't work out that way, and that's unfortunate. But if you're more selective in the stocks you picked throughout this Quantcha challenge, you could actually have done a bit better. And you can see on the right side, we've got the actual cash returns, and you can see that we did have a couple profitable trades that were illiquid, but it was heavily washed out by those that were not profitable. And a big chunk of that loss on the illiquidity side had to do with the illiquidity of the options themselves. So that's just the nature of the beast. Now let's talk about some silver linings, because while some things didn't go great on this, there's a bunch of things that are really important to talk about. Especially one thing we want to emphasize is that the Quantcha stock options search engine worked really well. It did exactly what we asked it to. We didn't think twice. I went through every week placing these trades. Once I set a budget, I never thought twice about whether the budget was actually the limitations that we were dealing with. I never thought twice about the quantities of legs that were being opened or anything else. All the math that was done, all the analysis that came through for us 100%, just as it's designed, and it helped us place a lot of trades, place them relatively quickly. Not that we were rushing through the trades, but we were just trying to be efficient. If you don't have to spend the time mapping out the charts, if the software can do that for you and if it can give you the probabilities, then that's what you really want to deal with. You don't want to be doing that stuff by hand these days. Another important thing is, despite the fact that we picked a lot of losing trades here, we didn't blow up our account, and that's a function of the budget and the legs and all of that and the risk being factored in. So at any given time when we placed a trade with Quantcha, we knew what our ceiling was, and that worked out very well because if you were to go out to talk to somebody who manages their own option trades and puts the same amount of time that we put in on the Quantcha challenge, and told them, hey, 7 of the 16 trades you're gonna go on are based on underlyings that will not go in the direction that you're trading on. The odds of them ultimately breaking even on the portfolio probably wouldn't be very high. It's very hard to do that if you're doing it by hand, and so the tools doing that for you really makes life a lot easier. Another thing that was a real nice side effect is that we had good diversification through the picks from Zacks. But not only the fact that the picks were diversified across industries and so on, but it's really nice to have long and short positions in your portfolio, especially if you're capped on the amount of loss and you understand the risk you're putting in there, because the market was pretty flat during this 2-month period. We had some generally movement, but it was always within a couple points of zero. I don't think the Dow and the S&P really didn't move outside of 1 point of zero. So the idea of having longs and shorts worked out well here. But in the event that you're in a bull market or you're in a bear market, having diversified longs and shorts, especially when they're based on good underlying calls, can help you a lot, because then if all the stocks go down, then odds are your bears are definitely going down. And if all the stocks are going up, then odds are your bulls are definitely going up. And if things are flat like they were for us, then you hope that your bulls and your bears go in the direction that you expect. Another important thing to break out here is we really wanted to focus on spread trades here. And this was the idea where, you buy an option at one level and you sell another one at a different strike. And by doing that, what we had originally planned for was to have, in liquid situations, a break even that was about where the money was. So that what we were really trading on was saying, if you give me a call on a stock, or, we'll say in this case Las Vegas Sands, if you tell us that you're bearish on Las Vegas Sands and it's trading at 53, we would structure a trade where it's profitable at or below 53. And while the return would only be, 30 to 70% over a few weeks, if the odds of it coming through are pretty likely if the underlying analysis is solid. Now we did that. We had 8 opportunities to apply that. And in doing that, only one of the trades exited at a maximum loss, which meant that it had to move against us significantly enough for it to take out the entire amount of money that that it was totally worth. And at the same time, 3 of those trades exited at maximum profit, which was nice because not only did we not have to, not only did we get the profit, but we didn't have to get out of the trades, meaning that we didn't have to take an additional hit on liquidity to sell one of the legs or buy it back. And so we were able to get that. And a lot of times when people look at these trades, the concern is that if you're only going to get let's say a 50% return with this strategy on a given trade for your maximum, then the idea is that you typically think, well, that means that I need to be right 2 out of 3 times in order to break even, and I need to beat that if I want to make a profit. But that's not really the case, because what happens is when you miss, for example, if someone is very bullish on a stock, and so you put that bullish trade in, and it's at 100, so you're going to profit at or above 100. If the stock closes at 98, odds are that your trade is structured in such a way that 98 isn't a complete loss. It went against the bullish view, but it wasn't like it dropped 10%. And so you do have to watch out for those big movements against your particular position. But if your view on the stock is remotely true, or at least if you're hedged enough where a little bit of movement against you does happen, you're not losing the significant amount. So in the case of our spread trades, what generally happened was, when we had one that worked against us, we would only lose 40% on the trade or 50% on the trade, and the ones that worked for us, we would have a nice gain of that 50 or 60%. So in the end, it really worked out to be about 1 to 1 for the most part. Every trade we had that profited had a comparable spread trade that didn't. And if you took any of the specific trades that went one way, ComScore is a good example. Like that one was lost based on one call. I mean, there was one day when it dropped about 10% on us, and that really killed things from a big surprise move. So and that can happen at any time, and it could have happened with any of the stocks. But that's the sort of thing to keep in mind. So wrapping things up here. We don't have specific details, but I can tell you, please stay tuned, because we are going to be launching another challenge in the near future. It is going to be very similar to what we did here, but we've learned a lot of lessons, and it's going to be a lot better. And we're pretty excited because there's going to be some better ways for people to participate. And if you've had an opportunity to participate in this challenge, we hope you did well, and we hope you stick around. And as always, if you have any questions or feedback, please hit us up at hello@quantcha.com. And thank you again for all the views and the comments. And happy trading.